You've probably heard some version of this idea: the house always wins. Casinos are built on math that guarantees them a profit, so owning one should be one of the safest bets in business. A machine that turns human hope into steady, predictable income. That idea isn't wrong exactly, it's just dangerously incomplete. The house edge is real. It is also, on its own, almost never the reason a casino makes or loses serious money. The real economics of owning a casino are stranger, more fragile, and far more dependent on debt, real estate, and the unpredictable behavior of a handful of very rich people than most gamblers, or most casino owners for that matter, ever fully appreciate. Start with the part everyone gets right. Every game on a casino floor is built around a mathematical edge in the house's favor. In blackjack, that edge might be less than 1% if you play perfectly. In American roulette, it's built into the wheel itself. Two green zeros that pay nothing, quietly siphoning off about 5 cents of every dollar wagered over time. Slot machines can run anywhere from a 2% edge to a brutal 15%, depending on how the machine is configured. None of this is a secret. It's printed in state gaming regulations, audited constantly and mathematically unbeatable if a player sits at the table long enough. So far, the popular story holds up. But here's the detail that changes everything. Long enough is doing an enormous amount of work in that sentence, and it's not a time frame most casinos actually get to operate on. The house edge is a statement about what happens across millions of hands, spins, and rolls. Not about what happens on a Tuesday night when one player with an enormous bankroll decides to bet the way most people are too afraid to. In the short run, variance doesn't just exist, it dominates. And when you attach a high enough stake to that variance, the guaranteed long-term math becomes almost irrelevant to whether a casino survives the week. This is where the real business of casinos starts to reveal itself. And it starts with a question most visitors never think to ask. Who is actually the customer that matters? The instinct is to picture Las Vegas as a city built on high rollers. Men in suits pushing stacks of chips across a baccarat table, while a boxer's entourage watches from the rail. That imagery isn't wrong, but it's misleading about where the money actually comes from. For decades, the overwhelming majority of a typical casino's gambling revenue hasn't come from high-stakes table games at all. It's come from slot machines and low to mid-stakes players. The volume business. Thousands of people feeding $20 at a time into a machine, over and over, hour after hour, losing small amounts that add up to something enormous and, crucially, extremely predictable. A slot machine floor doesn't care about a hot streak. It has thousands of independent, low-variance transactions happening simultaneously, which is exactly the condition under which the house edge behaves the way the math promises it will. High rollers are different, and not just because their bets are bigger. They're different because they introduce concentration risk into a business that otherwise thrives on the opposite. A casino would, in a purely mathematical sense, rather have 10,000 people lose $20 each than have one person wager $200,000 on a single hand. Both add up to the same total action. Only one of them can walk out the door in a single night having taken a chunk out of the casino's cash reserves that takes months to rebuild. So why do casinos chase whales at all? Because the economics of a casino floor are only one layer of a much bigger business, and the whale serves a purpose that has almost nothing to do with the table he's sitting at. High rollers generate marketing value, prestige, and this is the part that surprises people. They're often profitable not because of what happens at the table, but because of what the casino spends to keep them there, compared to what it can extract from their broader spending and reputation. A whale who loses a fortune becomes a story that draws other gamblers. A whale who's comped a private jet, a penthouse suite, and a personal host isn't just gambling, he's being managed as a long-term relationship, sometimes worth tens of millions of dollars in lifetime value, win or lose. Casinos build entire departments, staffed by hosts whose only job is nurturing these relationships, because a handful of these players can represent a disproportionate share of a property's table games revenue in a single year. That's the appealing version of the whale strategy. Outsized reward for a manageable cost. Comp a suite worth a few $1,000s a night, and if the player loses at anywhere close to the expected mathematical rate, the casino comes out enormously ahead. The problem is that this entire strategy depends on the player behaving like the math predicts, and high-stakes gamblers didn't get rich by being predictable. In 1990, a Japanese real estate speculator named Akio Kashiwagi walked into Trump Plaza in Atlantic City and forced the American casino industry to confront exactly how thin the line was between calculated risk and existential threat. Kashiwagi was known in gambling circles as the warrior, a baccarat player willing to bet limits that most casinos wouldn't even offer. Trump Plaza, eager for the prestige and the action, agreed to a marker, essentially a line of credit extended against future losses, and let him play at stakes far above normal table limits. Over the course of a single extended session, Kashiwagi won roughly $6 million from the casino. Not lost. Won. For most businesses, a single customer walking away with millions of dollars in a weekend wouldn't threaten the company's ability to operate. For a casino running on the assumption that variance evens out over volume, it was a genuine liquidity crisis. Trump Plaza had to scramble to cover the payout and manage its cash position. A scenario that exposed something the polished image of casino ownership rarely admits. A casino's cash reserves are finite, its obligations to pay winners are immediate and legally enforceable, and a bad enough short-term outcome can put a property in real financial jeopardy even when the long-term math is completely in its favor. The story didn't end with a lesson learned and moved on from. Kashiwagi returned to the tables, eventually losing back a significant portion of what he'd won, at one point owing the casino millions of dollars in gambling debt. But collecting that debt turned out to be its own unpredictable process, cross-border, dependent on a volatile individual's financial and personal circumstances. In 1992, Kashiwagi was murdered in Japan in a killing that was never solved, leaving a substantial portion of his debt to the casino uncollected. The episode became a cautionary tale across the industry. A whale isn't just a source of upside. He's a concentrated, largely uninsurable risk sitting on the other side of a legally binding credit agreement, and the casino has almost no control over the variables that determine whether that risk ever gets repaid. That single relationship illustrates something bigger than one dramatic weekend in Atlantic City. It shows that the modern casino isn't really structured as a gambling business at all. It's structured as a credit business wrapped around a gambling floor. Markers extended to high rollers function like unsecured loans, and a casino's exposure to a handful of major players can, in bad moments, resemble the concentrated risk of a bank that made a few enormous loans instead of thousands of small, diversified ones. This is precisely the kind of risk that sophisticated lenders spend enormous effort avoiding, and yet it's baked into the basic operating model of high-end casino gambling, because the prestige and volume a whale brings are considered worth the exposure, right up until they aren't. And credit risk from big players is only one layer of fragility. Underneath the gambling floor entirely, there's a structural reality about how modern casinos are financed that most visitors never think about. The casino you're standing in very likely isn't owned, in a real sense, by the company whose name is on the building. Over the last 2 decades, the casino industry has undergone a quiet transformation that mirrors what happened in retail real estate. Major operators, Caesars, MGM Resorts among them, sold off the physical buildings and land to separate real estate investment trusts. Companies like VICI Properties and Gaming and Leisure Properties, and then leased the properties back. The operator runs the casino, the restaurants, the entertainment, and pays rent, often under long-term leases spanning decades, to a landlord that has no involvement in gambling operations at all. This wasn't a minor accounting maneuver. It fundamentally restructured where risk sits in the industry. The real estate trusts collect steady, largely guaranteed rental income, regardless of whether the casino floor has a good or bad quarter. The operating company keeps the upside if gambling and hospitality revenue is strong, but also keeps the exposure if a downturn hits, while now carrying a fixed rent obligation on top of everything else, a bill that has to be paid whether or not anyone is pulling a slot lever that month. This split matters because it explains one of the more counterintuitive truths of casino ownership. The person who owns the casino, in the sense of running the business you interact with, is often not the person taking on the biggest financial risk of the building itself. The land and structure, the most stable, valuable, tangible asset in the whole equation, increasingly belongs to a separate financial entity built specifically to avoid gambling industry risk while still profiting from it. The people actually operating the casino floor are left managing the volatile part: labor costs, marketing spend, competition, and the unpredictable behavior of everyone from slot players to whales like Kashiwagi. That structure becomes especially important when you look at what happens when a casino simply misjudges its market, which brings us to a case that shows the whole system failing at once, not because of one dramatic gambler, but because of ordinary bad planning colliding with a changing industry. In 2012, a $2.4 billion casino resort called Revel opened on the Atlantic City Boardwalk, built as the most expensive single-tower casino property in the city's history. It was designed to be a turning point for a city that had been losing ground for years, a glass tower meant to draw a younger, wealthier crowd away from Las Vegas and toward the East Coast. The opening was framed as a triumphant bet on Atlantic City's comeback. The comeback never arrived because the ground underneath that bet had already shifted. Pennsylvania, New York, and other neighboring states had spent the previous several years legalizing and expanding their own casino gambling, giving East Coast gamblers destinations far closer than a drive or flight to the Jersey Shore. Atlantic City's core customer base, regional day trippers rather than destination vacationers, had far less reason to make the trip. Revel had been financed with enormous debt, built on the assumption that its scale and design would draw enough new visitors to justify the investment. Instead, it was competing for a shrinking regional gambling market with a fixed massive debt load and equally massive fixed operating costs, in a building specifically engineered not to survive as a smaller, leaner property. The warning signs showed up almost immediately. Within its first year, Revel was burning through cash faster than it was generating it, and by 2013, barely a year after opening, it filed for bankruptcy protection for the first time. It emerged, restructured some of its crushing debt, and tried again. It wasn't enough. A second bankruptcy filing followed within another year, and by the summer of 2014, Revel closed entirely. A $2.4 billion building sold at auction for a fraction of its construction cost, roughly $82 million, in a sale to a Florida developer, later then eventually resold again. A property built to be the future of Atlantic City lasted barely 2 years as a functioning casino before becoming one of the most vivid examples in modern gambling history of how quickly the economics of casino ownership can collapse when debt, overbuilt scale, and a misjudged market line up at the same time. What Revel proves isn't that casinos are inherently unprofitable. Plenty of properties in the same city and the same era were surviving, even thriving. It proves that the profitability of a casino has very little to do with whether people are gambling and losing money in the mathematically expected way, and almost everything to do with whether the underlying financial structure, the debt load, the fixed costs, the assumptions about foot traffic, was built for the market that actually shows up, not the market the owners hoped for. That's the pattern connecting every part of this. A whale who wins $6 million in a weekend, a debt that becomes uncollectible, a casino separated from the building it operates in, a billion-dollar tower that couldn't survive a shift in regional competition. None of these are failures of the house edge. The math on every slot machine and blackjack table in every one of these buildings worked exactly as designed. What failed again and again was the assumption that a business built around a guaranteed long-term statistical edge could be managed with short-term thinking, heavy debt, concentrated credit exposure, and construction bets sized for a best-case future rather than a realistic one. The industry has adapted in visible and less visible ways. Casino operators today lean far more heavily on non-gambling revenue than the popular image suggests. Hotel rooms, restaurants, nightlife, retail, and entertainment now make up a majority of total revenue at many major Las Vegas properties, not the gambling floor itself. That shift represents a quiet acknowledgement that gambling revenue, while still central to the brand, is not reliable enough on its own to anchor a business this capital-intensive. The rise of real estate investment trusts owning the physical properties reflects the same lesson from a different angle. Separate the stable, predictable asset from the volatile operating business, and let each be owned by the party best suited to carry that kind of risk. So if you compare the optimistic version of casino ownership with the realistic one, the gap is enormous. The optimistic version is the one most people imagine, a guaranteed mathematical edge translating directly into steady profit decade after decade, with risk essentially engineered out of the business. The realistic version is a highly leveraged operation, juggling enormous fixed costs, competing for a customer base that can vanish the moment a newer casino opens, extending credit to individuals whose behavior can swing millions of dollars against the house in a single session, and increasingly renting the very ground it stands on from a landlord who took none of that risk in the first place. Some operators manage this balance skillfully for decades. Others build the next Revel, a monument to a bet that assumed the future would look like the past. So what is a casino actually built on? Once you strip away the imagery of chips and neon and the guaranteed math everyone already knows about. Not gambling, not really. A casino is a business built on managing other people's psychology, other people's debt, and someone else's real estate, all balanced against costs that don't care whether the dice are cold. The house edge was never the risky part. Everything built around it was.